Welcome to video 3 of part 3 of the EA Tax Training Enrolled Agent Exam Preparation course. Tom here back with you to discuss specific areas of representation before the IRS. In video 2, we talked about representation in general. In this video, we'll talk about specific types of issues you might be engaged to assist with. Specifically, we will talk about the collection process, penalty and interest abatement. Then we'll talk about examinations, otherwise known as audits. And finally, we will talk about appeals. Our free resources from irs.gov, the first two look familiar, Circular 230 and Publication 947. And we've added a couple of forms in their instructions. Form 433, that series of forms, that's the collection information statement. And then Form 843 is the claim for refund and request for abatement. So let's start with the collection process. First, what are the different methods you can use to pay your taxes? Well, you can do direct pay right from your bank account. You can use a credit card or a debit card. You can create an online account with the IRS, and then you can pay there and you can see your payment history. Most businesses will use the Electronic Federal Tax Payment System, otherwise known as EFTPS. You will want to know what that stands for the exam. You can pay by wire transfer. You can send a check or money order through the mail. You can use electronic funds withdrawal when you e-file your tax return. And you can actually pay cash up to certain limits through certain retail partners that the IRS partners with throughout the US. So that's your payment options. What about your refund options? Well, you can get direct deposit into your bank account, and you can split that into as many as 3 different bank accounts. You can get a paper check through the mail. You can get a prepaid debit card. So sometimes clients won't have a bank account and they can get a prepaid debit card instead. The IRS is using some mobile payment apps, and I think that will expand in the future. You can get U.S. savings bonds instead of getting a direct refund of cash. You can apply your overpayment to next year's estimated taxes, or you can split your overpayment between getting a refund and then using part of it for next year's estimated taxes. What if you just don't have the money? Well, first of all, you want to file your return anyway. So the failure to file penalties are greater than the failure to pay penalties. And it's for a reason. The IRS wants to encourage you to go ahead and file your return, even if you can't pay. Sometimes you'll have clients who are basically embarrassed that they can't pay. And so then they end up not filing their return, or they think they're not allowed to file their return if they don't pay. But you want to talk to them and counsel them that yes, they can. And not only can they file their return, they should file their return. Also, another reason you want to get that filed is because of that statute of limitations that we talked about. Remember, the statute does not start unless and until the taxpayer files a tax return. So IRS has got 3 years to go back, but that clock doesn't start ticking until the return is filed. If you file and you don't pay, then the IRS is going to send a bill, and that's going to include interest and penalties. Then if you don't pay that one, they're going to send you at least one more. And then if you don't pay after receiving your final bill, then they are going to begin collection actions. So what are your options if you can't pay right now? Well, you've got 3 options. We'll talk about each of these in more detail. You can request an extension of time to pay. You can request an installment agreement, and you can request an offer in compromise. So an extension of time to pay, you apply on Form 1127, and you can see the name of the form is Application of Extension of Time for Payment of Tax Due to Undue Hardship. This must be filed either with your return or if you received a deficiency letter by the date shown on the letter for payment. So if you get a deficiency letter, it's going to say you must make payment within certain number of days of the date shown on this letter. So you'd want to file this form 1127 by that date. An extension of more than 6 months will usually not be granted if you are filing this 1127 with a tax return, and an extension of more than 18 months will usually not be granted if you are filing it in response to a letter of deficiency, although it is possible to get an additional 12 months in some exceptional circumstances. In order to get the extension of time to pay, you have to provide a detailed explanation of the undue hardship that will result if you were to pay the tax when due. A general explanation will not suffice. You can't just say, because I can't pay right now. You have to say specifically what is the issue and what is the undue hardship. You must attach a statement of your assets and your liabilities and an itemized list of your income and expenses for each of the previous 3 months. Once the IRS reviews it, they may impose additional conditions, and interest will still accrue. However, penalties will be forgiven as long as you pay within the agreed upon time period. So this is the real incentive to request this extension, is you can get those penalties waived as long as you do in fact pay within the time period you say you are going to pay. Next option is an installment agreement. So this allows you to make payments. Usually they're going to be monthly payments over time in order to pay off the amount that you owe in full, along with any interest and penalties. The maximum time is 72 months. You will want to know that for the exam. So that's 6 years, or it's expressed actually in months. So 72 months. In order to qualify, all tax returns must have been filed. The agreement must result in the full amount being paid. This is not a way to negotiate a lower amount. There is a setup fee, is less if the application is made online rather than on paper. You can apply online at this reduced fee if the total amount owed is $50,000 or less, and you will know immediately whether or not you are accepted. So the IRS, the online form, will give you an answer immediately about whether or not you qualify. And the amount can actually be up to $100,000 if your plan will pay off the total amount due in 180 days or less. So that's about 6 months or so. So it's up to $50,000. You can go up to 72 months and have this reduced fee, and you'll know immediately what the answer is. Up to $100,000 if you're going to pay within 180 days. You can also apply by phone, or you can apply by mail by using Form 9465, or you can actually walk into a local IRS office and apply in person. The payments, all of the installment payments, can be made by all the regular methods that we already talked about how you can pay your taxes. A reduced fee is going to be granted if you set up direct debit from a bank account, and that setup fee will be waived altogether for low-income taxpayers who use direct debit. You may be asked as part of the process to complete a collection information statement. That's the 433 series of forms, and that shows your assets, liabilities, income, and expenses. And interest and penalties do still accrue while you are making an installment agreement. So an installment agreement will not get you out of any interest or any penalties. It just allows you to pay them over time. As a matter of fact, you're going to keep accruing them. So as you're making the payments, there is still interest and penalties accruing on the part that has not yet been paid. Next is the offer and compromise, and it is important that you understand this because this is what you hear all the radio ads and TV ads and online ads about. So let's understand what they're talking about. So this is an agreement between a taxpayer and the IRS that settles a tax debt for less than the full amount owed. So I'm sure you've heard those commercials where they have these people come on and say, oh, I had this big tax debt and XYZ company got it reduced and I paid 10 cents on the dollar. You hear all of these kind of ads. And those ads are very misleading, in my opinion, and in the opinion of the IRS. They've actually put out warnings to the public about these companies that advertise this, because they make it sound like anybody with an amount due, as long as you owe enough. Sometimes they'll say, if you owe $10,000 or more, then talk to us. It makes it seem like if you owe that amount or more, that it's an easy thing. You just walk into the IRS, you negotiate a lower amount of tax, and then you settle at pennies on the dollar. Well, as you're going to see here, it is not that easy and it is not that common. So the IRS will generally accept an offer if the taxpayer qualifies, which we'll talk about, and the IRS does not expect to be able to otherwise recover more than the amount offered. This is called doubt as to collectability. So this is the old blood from the turnip. If the IRS looks, says, well, this person really doesn't have many assets, they don't really have much income, we're probably not going to really be able to collect this. Well, in that case, then yes, they may in fact settle for pennies on the dollar. But as we're going to see, not quite that easy. In order to request this offer in compromise, you use this form, Form 656, and you do pay a fee in order to do that. And you must also complete a collection information statement along with that. In order to qualify, the taxpayer has to meet all of these requirements. First of all tax returns must have been filed. Taxpayer must have received a bill for at least one tax debt that is included in the offer. They have to make all required estimated tax payments for the current year. So you can't be behind on your current taxes and request an offer in compromise for old taxes. If the taxpayer is a business owner with employees, they must have made all required federal tax deposits for the current quarter and 2 preceding quarters. Taxpayer cannot be in bankruptcy, cannot have an open IRS audit, cannot have any outstanding innocent spouse claims, and cannot have the ability to pay in full through an installment agreement or equity in assets. So this is the one that's really going to trip up a lot of taxpayers. If you have the ability to pay, either through some assets that you own or through an installment agreement, then you cannot get an offer in compromise. You really have to not have much in the way of assets or income in order to qualify. That's why these ads are so misleading, because they make it seem like anybody, no matter their financial position or how many assets they have or what their annual income is, that anybody can walk in and negotiate a lower tax. But it is simply not that easy. If it were, everybody would do it, and the IRS would end up accepting a lot less in tax than they should. So they don't want to encourage people who can pay to do this. So they make it very difficult to qualify. Another type of offer in compromise. So the one that we were just talking about was that doubt as to collectability. There's also a doubt as to liability. So if there's a genuine doubt about the legitimacy or the amount of the tax liability, then the taxpayer can file Form 656L, and there's no fee charged for this one. Now, you cannot apply for both doubt as to collectability and doubt as to liability, but this could be one where the tax that is due is because of some gray area in the tax law. And you look at it, you're representing the client, and maybe it's an area where you can make a pretty good case. Remember, we talked about all that tax research that you'll do. You might be able to make a pretty good case that, hey, I don't know that they really owe this amount of money. And so you can negotiate with the IRS. If the IRS agrees that it's kind of a gray area and maybe they're not quite right, then you can negotiate a smaller amount due as an offer in compromise due to a doubt as to liability. If the offer is denied, then the taxpayer can appeal within 30 days, and we're going to talk about appeals later in this video. And there's an online tool that taxpayers can use to see if they may qualify. It's at irs.gov/OIC tool. Next is collection actions. So the IRS has several ways to collect unpaid taxes. First of all, they can levy income or property. And a levy is the same thing as a seizure. So, in other words, they can seize your assets or seize your income. They can also place a lien on property. They can issue a summons. They can revoke or not issue a passport. And they can offset future tax refunds to pay amounts that are due. So, let's talk about each of these. So, a levy and a seizure are the same thing. And the way the IRS does it is they issue this notice of levy. However, they have to send that to you or to the taxpayer in advance. Normally, they have to wait at least 30 days after they send the notice of intent to levy before they actually seize the property. The IRS cannot levy if there is a current or pending installment agreement, offer in compromise, or if the IRS agrees that the taxpayer is unable to pay. So if you are already paying or you're just setting up an installment agreement or an offer in compromise, then they can't seize your assets in the meantime. Or sometimes the IRS will just look at the situation and they'll say, okay, we know the person can't pay, and so we will not seize the assets. Here are examples of the types of property that the IRS can seize. They can seize wages, salary, or commission. They can seize dividends and loan payments that are being received. They can seize bank accounts, retirement accounts, federal payments that are to be received, such as retirement income, Social Security, payments on federal contracts, and they can seize your house, your car, and other property. There are some types of property that the IRS cannot seize. So they cannot seize unemployment benefits, certain annuity and pension benefits, certain service connected disability benefits, such as military disability benefits, workers' compensation proceeds they cannot seize, certain public assistance payments. A minimum amount of weekly income is exempt from seizure. In other words, they can't take your whole paycheck. They have to leave you enough to live on, a minimum exempt amount. They cannot seize assistance under the Job Training Partnership Act, and they cannot seize income from court ordered child support payments. So if you're getting child support, they cannot take your child support payments. Next is a federal tax lien. So a lien is a legal claim against all of the taxpayers' current and future property. So it applies to properties such as the taxpayer's home, their car, and any property rights that they may have in the future. A notice of federal tax lien gives public notice to creditors. The IRS files the lien to establish priority of their claim versus other creditors. So basically, once the IRS files a federal tax lien, nobody's going to want to lend you money because, for instance, let's say you've got a house and you think, well, I'll go get a second mortgage on the house. Well, nobody's going to do that because they're going to look and see that there's already a federal tax lien. So they're not now going to give you a mortgage on that home. The IRS can only issue the lien after they've assessed the tax, sent a notice and demand for payment, and the taxpayer has not paid within the given time period. Once the amount has been paid, the lien will be released. Or if an offer in compromise has been satisfied, it will be released. Or once the statutory collection period is run out. So that, remember, that's that 10 years they have in order to collect. So the lien will be released in any of those circumstances. The IRS may withdraw the lien in certain circumstances. So first of all, if you enter into an installment agreement, then they will usually withdraw it if it will help the taxpayer to pay their taxes more quickly. So maybe you, as the taxpayer's representative, you go to the IRS and say, hey, they're willing to go get a second mortgage on their house in order to pay the taxes, but they can't do that because of this lien. Well, then the IRS would then say, okay, we'll withdraw the lien as long as you agree that they're going to get that second mortgage and pay off that amount. They'll also withdraw it if they, the IRS, did not follow their own procedures in issuing the lien. If it was filed during a bankruptcy automatic stay period, they will withdraw it, or if it's in the interest of both the taxpayer and the government. Next thing the IRS can do to try to collect an amount due is to issue a summons. So, a summons legally compels the taxpayer or some other person to meet with the IRS and to provide information or documents or testimony. The taxpayer may be required to testify, to bring books and records or other documents, and to prepare a collection information statement. If a third party is sent a summons, such as a banker or an employer, then the taxpayer will be notified and have an opportunity to have it quashed. In other words, they'll have an opportunity to say, hey, you don't need to talk to them. That person should not be summoned. That would be quashing that summons. If the third party summons is to collect a tax already owed, then no notice will be given. In other words, if they're going to go to that third party, they're sending the summons to your employer in order to get money in order to pay the tax. They're not going to give you a notice. So you don't have a chance to go to your employer and say, hey, ignore that summons when you get it, for example. Actions against passports. So the IRS is required to notify the State Department of taxpayers who owe what's called a seriously delinquent tax debt, and it has to be generally more than $59,000. Once they do that, the State Department will not issue or renew a passport, and they may revoke an existing passport. So this accomplishes a couple of things. First of all, it can be an incentive if somebody wants to travel overseas and they want their passport, then this gives them an incentive. And then secondly, it can help to prevent people from fleeing the country in order to avoid paying the amount of tax due. Refund offsets. The taxpayer has an outstanding debt. Any refunds that they may then have. So they file the return, they have a refund due. Well, if they owe back taxes, instead of issuing that refund, the IRS is going to keep it in order to offset that previous debt. As part of this Treasury offset program, they can also keep the refund to pay other amounts that are due. So, for instance, past due federal student loans, state income tax due. So, they'll have agreements with states that say we will withhold their refund in order to pay the amount that they owe to you. Child support payments. So, if the person's behind on child support payments, they'll take the refund for that. And there can be other amounts that are due to government agencies that they'll do the same thing. Collection appeals. So the taxpayer does have the right to appeal most collection actions. And appeals is a separate and independent part of the IRS. So they are separate from the IRS collection office. And the taxpayer and or the representative, that's you, will be invited for a conference so that it can present documents, make comments, make your case, negotiate, whatever you want to do. There are two main options that you have for collection appeals. Something called collection due process and then the collection appeals program. Collection due process, the purpose of this is to have appeals review the collection actions that have been taken or that have been proposed to be taken. So you can request, or the taxpayer can request a hearing if they've received any of the following things: a notice of federal tax lien, a final notice of intent to levy, a notice of jeopardy levy, a notice of levy on your state tax refund, or just a general notice of levy. So it's just for a tax lien or some type of levy, you can request this collection due process hearing. You requested on this form 12153. You must request it by the date in the notice. And once you request that hearing, then the IRS usually is going to stop any type of levies for the time being until you can have your hearing. Again, when you have that hearing, you can make your arguments, you can show whatever documents you have, You can negotiate. You can propose an installment plan, an offer and compromise, etc. And then if the taxpayer does not like the answer from this hearing, they can actually appeal to the courts as long as they followed all the rules when they requested that hearing. Next is the collection appeals program. Before you can file for this collection appeals program, the taxpayer has to request a conference with the manager of the IRS employee who made the decision to levy or to file the lien or about the installment agreement. So you can't just deal with the first person you talk to. Before you can go to this collection appeals program, you have to say, hey, I want to meet with your manager, and then meet with that manager. And again, it doesn't have to be the taxpayer. This can be you as the enrolled agent, as long as you have that power of attorney. If the taxpayer disagrees with that manager, then they can request the collection appeals program hearing. You have to let the collection office know within 2 business days of the intent to appeal. So if you have that meeting with the manager, you don't like the answer, then within 2 business days, you have to say, hey, we are going to appeal. And then you file this Form 9423 in order to request that hearing. This program, the CAP program, can be used in more circumstances than that CDP that we talked about. So it can be used before or after the IRS files a notice of lien, before or after the IRS seizes property, or after the IRS rejects, terminates, or proposes to terminate an installment agreement. So if you want an installment agreement and the IRS is not agreeing with it, then this is how you can appeal that. Then the taxpayer and or the representative will meet with appeals, present their case, and if the taxpayer doesn't like it, then they can go to court. They can appeal that to the courts. Currently not collectible. So the IRS can determine that somebody is not collectible. And you can request this on behalf of a taxpayer. You can request for the IRS to review the situation and to make this determination. But this is only going to be in kind of the most desperate, dire type of circumstances. But once the IRS agrees to this, then that will delay all collection efforts, though the IRS may still file a lien to protect their interests. In order to get this, you have to be able to prove that the taxpayer does not have assets or income in order to pay, and you have to file a collection information statement. This does not eliminate or lower the debt in any way, and interest and penalties will still continue to accrue. And then the IRS is going to do an annual review of the ability to pay, and you can apply for this by calling the IRS. So this would be a situation where, let's say, I'm just going to give you an example. Let's say you've got a client and they're going to prison. So they've committed a crime, they're going to prison. So they're going to go there and they're going to make 10 cents an hour working in the prison shop or whatever. And they don't have much in the way of assets. You can call the IRS, explain the situation, say, hey, look, you're not collecting this, and they will put it into this currently not collectible status. However, as we said, the debt doesn't go away, and interest and penalties are still going to accrue. So this really is a last-ditch thing you would do just to keep the IRS from harassing you. But what you really want to try to do is one of those other options in order to get some sort of agreement, an offer and compromise, something so that you can take care of the debt and that it's gone and that there's no more interest or penalties. But this is an option that you have in those circumstances. Representing a decedent. If a taxpayer dies while owing the IRS, then the debt will transfer to their estate. So if they've got assets, then the estate will end up having to pay the taxes. So the IRS will send a notice of federal taxes due to the holder of the assets, to the bank or to the owners of the property, etc. Any tax liens are against the property itself, not against the person. So those liens will remain in effect. If the tax debt was from a jointly filed return, then the spouse is responsible. Remember, you file jointly with your spouse. You are jointly and severally liable for that debt. So just because your spouse dies doesn't mean you don't have to pay the tax, or you don't have to pay half the tax or something. You still owe the total amount of the tax that is due. If there is no surviving spouse and there's no assets, then that's it. The IRS just isn't going to get their money. So unless there's been some sort of fraud committed, the children, for instance, of a taxpayer are not responsible for the debts of their parents. So if the taxpayer dies, there's no assets, or whatever assets they have, they've used to pay the tax, but there's still more tax due, then the tax just disappears and the IRS are not going to get their money. Trust fund recovery penalty. We talked about this previously, but let's talk about it again. If amounts are withheld for Social Security and Medicare, remember those are the trust fund taxes. If those are not turned over, there is that 100% penalty. And if the business can't pay it, then any individual who acted willfully can be made to pay. And remember, any individual doesn't have to be an owner. It could include an officer, an accountant, a partner, or even volunteer directors. The next area where you may represent clients before the IRS is in penalty and interest abatement. So, in certain circumstances, the IRS will abate or forgive penalties that they would normally impose. Sometimes, but not very often, they may also abate interest. And you, as an EA, can represent taxpayers through this process. This is often part of a collections engagement. So you're dealing with an amount due by the taxpayer, you're negotiating with the IRS. Maybe you're negotiating one of those things we just talked about. And as part of that, you might also negotiate an abatement of penalty and or interest. Or sometimes you might just be engaged to try to get this penalty or interest abatement. So penalty abatement. So these are the types of penalties that can be abated. So what we're usually going to be dealing with is failure to file and failure to pay. But you can see here on the screen all the other different types of penalties that may be abated. So there are 3 different reasons that you may be able to get a penalty abatement. You've got something called the first time penalty abatement and administrative waiver, reasonable cause, or a statutory exception. So the first time penalty abatement. So this is for taxpayers who have a history of good tax compliance. So they're filing their returns, they're paying their amounts due, but now something happened. Whoops, we didn't pay, for instance, and now we've got a penalty. So good tax compliance means that you filed this same type of return for the last 3 years, if it's been required, and during that time you haven't had any penalties, or you didn't have any penalties that were abated for some reason other than first time abate. As the name implies, this is the first time, but it doesn't have to be the first time ever. They're just looking back 3 years. If you are granted this, then interest on the penalty will also be abated. So the penalty itself will be abated and the interest on the penalty will be abated. However, the interest on the tax itself will not be abated. So you'll still have to pay the interest on the taxes. You just won't have to pay the penalty or the interest on the penalty. There are 3 types of penalties that are eligible for first-time abate. That's failure to file, failure to pay, and failure to deposit. So, for instance, when you've got payroll taxes that you are supposed to be depositing on a regular basis, and you fail to do that, there's going to be a penalty. Well, if you qualify, then that is one of the penalties that can be abated. Administrative waiver. So a first time abate is a type of administrative waiver, but there are other types of administrative waivers as well. The other types can be found in IRS policy statements and news releases. So a lot of times these will be due to natural disasters, last minute tax legislation, or other unusual circumstances. So example, new tax legislation is passed late in the year, IRS guidance on the new legislation is delayed, causing some taxpayers to miss payment deadlines. The IRS then issues a news release announcing penalty relief for all affected taxpayers. So this can happen. Congress can pass tax laws whenever. So they might pass a law in December that applies to that year. So let's say they pass it in December of 2023 and it applies to all of 2023. Then taxpayers are waiting for guidance from the IRS about how to apply that new law. And so they can't file their return until they get the guidance. And so because they can't file their return and pay their tax on time, they have a penalty. The IRS then can step in and say, okay, because there was this delay, we are going to not penalize you for filing late in this circumstance. Reasonable cause. So reasonable cause is determined on a case-by-case basis. So some examples is, again, a fire or a natural disaster or a civil disturbance. If the taxpayer is unable to get records for some legitimate reason due to a death or serious illness of the taxpayer or of a family member, or if there were system issues that delayed a timely electronic filing or payment. So with all the technology that we have these days, sometimes there are issues with things and you were trying to, for instance, file on time, but there was a glitch with the electronic filing. So the IRS can look at that and say, okay, we will waive the penalty in this particular case. There are some reasons, however, that do not qualify. So first of all, reliance on a tax professional. So the taxpayer cannot say, hey, I thought my tax preparer was going to file that or do that. That is not a reason to get an abatement. Lack of knowledge. So you didn't know about this requirement. Well, as the old saying goes, ignorance of the law is no excuse. So just because you didn't know about it is not going to be a reason to not have to pay the penalty. A simple mistake or oversight, again, not a reason to abate. And just not having the money. Lack of money, as we've said before, if you don't pay, interest and penalties are going to continue to accrue. Statutory exceptions. So there are some times when by law, the IRS cannot penalize the taxpayer. So here are the common ones. If the taxpayer relied on incorrect advice from the IRS. So this does happen. You call the IRS, you say, what should we do? The IRS person you're talking to gives you bad advice. You would, of course, you would want to document that. Those phone calls are recorded. So you would want to, anytime you talk to the IRS, you want to make note of the date you called, the time you called, and get the name or identification number of the person you're talking to so that you can say later, hey, I talked to this person on this time and this date, and this is what they told me. They can go back and listen. Another exception is if you mailed or e-filed your return on time. So usually it's going to be when the return was postmarked. So if you mail your tax return, let's say it's your 1040, you mail it on April 15th and it's postmarked April 15th, and you can prove that, then there will not be a penalty. This is another reason if you're sending something to the IRS, I recommend you send it certified mail return receipt requested because that will prove when you mailed it. Also, if you live in a federal disaster area, they will abate penalties for a certain period of time. Or if you were in a combat zone in the military, then they will abate penalties as well. Now let's talk about interest abatement. So the IRS may reduce the amount of interest owed only if it was due to an unreasonable error or delay on behalf of the IRS. So it's difficult to get interest abated because it has to be due to a problem on the IRS's end. That's generally the only reason they are going to abate interest. So all of the following criteria must be met. You have to have filed your claim within the statute of limitations. You remember that, the 3-year, 2-year rule. It has to pertain to interest on income, estate, gift, or certain excise taxes. The error occurred after the IRS contacted you about an audit, an underpayment, or a payment. Neither you nor your representative, which you as the EA are the representative in this case, neither you nor your representative contributed to the error or the delay. So if part of the problem was something that the taxpayer did or that you as the enrolled agent did, that either caused the error or delay or contributed to the error or delay, then they will not abate it. So let's say, for example, you call the IRS and you give them incorrect information, and therefore they give an incorrect answer, they make an error. Well, they would not abate interest in that case. And then the unreasonable error or delay that occurred must be during the IRS's performance of ministerial or managerial acts. So that is most of what the IRS is doing. If the IRS just messed up, then they will, in some cases, abate that interest. Interest recalculation. So they may only abate the amount of interest that accrues during the period in which there was an unreasonable error or delay. So, for example, taxpayer files a balance due income tax return. An audit resulted in additional liability, tax and penalty, but there was an unreasonable delay during the audit. Well, the IRS is only going to consider the interest that accrued on the audit liability, the additional tax and penalty for abatement, not interest on the underpaid original liability. So you filed a tax return, had an amount due. Well, the amount that was due when you filed the return, you're still going to pay interest on that. In this example, the only interest you're not going to pay is the amount on the extra that they said you owed after they did their audit. In order to request an abatement for either interest or a penalty, most of the time you can do this by just calling the IRS. You can also do it on a form. You can use Form 843 in order to request it. And if you've already paid the interest or penalty and it gets granted, then they will refund the money. So sometimes you pay the interest or the penalty, or the taxpayer pays it, and then they come to you and you're talking to them and you're looking at them, and you might look and say, hey, you've got a good payment history. You probably qualify for first time abatement, for example. And then you can go ahead and request that first time abatement. And if it's granted, then they will send the taxpayer a refund. Now let's talk about everybody's favorite topic, examinations, otherwise known as audits. In these terms, examination and audit are used interchangeably. And it's important to remember that the IRS accepts most tax returns as filed without ever doing any kind of audit. The vast majority of tax returns are never audited. However, of course, they do some audits because they want to make sure that people are complying with the law. Just because a taxpayer's return is chosen for audit doesn't mean that they did anything wrong. In many audits, believe it or not, this is true, many audits result in a refund or no changes being made. So sometimes people think if they're getting audited, they're automatically going to owe more money, and that's just not true. Your return might be chosen. You did everything correctly. The IRS looks at it, says, yep, you did everything correctly, nothing due, and they move on. And believe it or not, if they look at your return and say, no, you made a mistake, and we, the IRS, we owe you money, they will send you a refund. That doesn't happen as often as the no change, but it does happen sometimes. Most audits also are done through the mail. So again, when people think of an IRS audit, they're thinking about somebody knocking on their door and wanting to do an audit, or the IRS calling them into their office. And of course, that happens. But most of the time, it doesn't. Most of the time, it's just done through the mail. It's called a correspondence audit. The IRS will send the taxpayer a letter. They'll request additional information, and then you just respond by sending that additional information, and then the IRS reviews it. Some audits, though, of course, are handled in person, and they can be at the taxpayer's home or business, at a local IRS office, or at the office of the taxpayer's representative. So they might be at your office as the enrolled agent. So again, they're not just coming and knocking on your door and saying, hey, we're here to audit you. They are going to send you a letter in advance saying, hey, we want to meet to audit you. Now, if there's been a crime committed, then the IRS's criminal investigation division, they might show up and knock on your door and have a warrant and all of that, but that's a whole separate matter. For a normal audit, that doesn't happen. That's not the way it works. And when you have this meeting with the IRS, the taxpayer can go by themselves. They can go along with you as their representative, or you can just go as their representative. Remember, you're going to have that power of attorney. Once you have that power of attorney, you can attend these meetings on the client's behalf. So, how does the IRS select returns for audit? Well, they have this computer scoring system, the Discriminatory Inventory Function System, or DIF system. It assigns a score to each individual and some corporate tax returns. A higher score indicates a higher potential for errors and thus for an audit. But also there is random sampling. So they do just take some returns. Yours just happens to get picked and it gets audited. There's also this document matching. This is where the IRS matches your reported wages with your W-2 or your 1099, etc. And if there's a mismatch, could trigger an examination. We'll talk a little bit more about that here in a minute. They could audit you due to other information that they receive, such as from public records, from newspapers, and from individuals. So they do have a whistleblower program. So usually this will be an employee, for instance, of a business, and they'll see something that's going on, and they will then go to the IRS and they'll say, hey, my employer is not paying all of their taxes that they should be paying. And then if the IRS sees that as being credible, they will go in, they'll do an audit, and they will determine whether or not there is amounts due. And then the taxpayer who's making that whistleblower claim can actually get a percentage of the amount of tax that is recovered. The IRS can also just, they can read the newspaper or these days read online news just like anybody else can. So if they see a situation, let's say somebody's arrested for embezzlement or a Ponzi scheme or something like that. Well, if the IRS hasn't already been included in that investigation, then they might go and say, hey, look, I'm guessing that person who just embezzled that money did not pay their taxes on the amount that they stole. And of course, 99.9% of the time, they have not paid the taxes on the amount they stole. So they might then start an audit because of that. So that's examples of things that they might do. And then also they might examine one return due to a related examination. So for instance, if they are examining a partnership tax return and they find problems, well, then obviously the K-1s that the partnership issued are likely to be wrong, which means the 1040s or other tax returns that were filed by the partners are likely to be wrong. And so then they can start auditing those returns as well. CP 2000 notice, this is when there is that mismatch between the taxpayer's tax return and a document that is received, such as a W-2 or a 1099. When this happens, the computer will just automatically spit out a notice, one of these CP 2000 notices. So the letter outlines what the discrepancy is and gives the taxpayer the opportunity to respond. If the taxpayer agrees, then they can just sign the response form and send in any amount that is due. But if they disagree, then they can complete the response and include any information or documentation for support of their position. So let's think about a couple of examples in each direction here. You could have a client who has multiple jobs during the year, and maybe they worked at one place for 2 weeks and then they quit. And in the meantime, they've moved. And so they never got the W-2 from that job that they worked for 2 weeks, and they didn't even think about it. They forgot about it. So they bring you all of their information. Does not include the W-2 from that 2 week job. It includes their other W-2s. You go ahead, you file the tax return, you think everything is cool, and then they get a CP 2000 notice because they got a paycheck and it was reported on a W-2 that was not included in the tax return. So in that case, you would look at it, talk to the taxpayer. They'd be like, yeah, I forgot about it. Never got the W-2. You would just say, okay, looks right. Sign the form saying that they agree, send in whatever tax is due. On the flip side, you could get 1099. So, for instance, you've got these 1099Ks that get issued by credit card companies, for instance, but then businesses also will issue 1099s. Well, a business should not issue a 1099 for amount that it was paid, for instance, by credit card, because the credit card companies handled that. But sometimes people make mistakes. So they might issue you a 1099 for income that you've already included on a different 1099, and there's going to be a mismatch. And so it could be that you have to write to the IRS and say, hey, here's what happened. This income was double counted, so I really didn't have that much. And you would just include whatever documentation that you had. So now let's talk about the audit process or the examination process. First thing is the IRS notifies the taxpayer by mail. For audits that are conducted by mail, the letter will request whatever additional information they want for certain items on the tax return. If it's an in-person audit, then the letter will provide contact information for the person at the IRS that they need to talk to. And it may also say, hey, we want certain books and records. We want you to bring those to the audit. Then the taxpayer or their representative, you as the enrolled agent, either mails in the requested information if it's a correspondence audit, or you bring that information to the in-person audit. So what happens is if it's an in-person audit, they send you the letter, they say, hey, contact us to set up a time. Then you, let's say you as the enrolled agent, would just call the person named in the letter, and then you would set up a time and place for the meeting. And then you would go to the meeting and bring whatever documents they asked you to bring. Once the audit is over, the revenue agent is going to write up a report of their findings. It's called a revenue agent report, and it can have one of three different outcomes. There can be no change. They can say, yep, everything is good, no change. Agreed, meaning the IRS is proposing a change and the taxpayer agreed. So it could be that the IRS says, hey, you owed money, taxpayer agrees they owed money, or could be the IRS owes the taxpayer money and the taxpayer, of course, agrees. Either way, that is agreed. Or it could be disagreed, which means the IRS proposes a change, but the taxpayer does not agree with it. If the taxpayer does agree, then they sign that closing form. You, as the enrolled agent, if you got the power of attorney, you can sign that closing form on their behalf. So you can go to the meeting, client doesn't have to be there. And as you agree with everything, of course, you're going to consult with your client. And this usually, unless it's very straightforward and very simple and there's no change, usually the closing form is not going to be right there at that first meeting. It's going to happen later. So you're going to be talking to your client. But if everybody agrees, then you can sign that closing form and then it is done. If the taxpayer does not agree, then the IRS will explain, here's your rights to appeal, etc. And what you can do is request a conference with the manager of that person if you want to, or you can file an appeal, either way. Usually it's a good idea just to go to the manager, say, hey, look, we disagree, and see if you can get the manager to bend a little bit. But if they won't, then you can file an appeal. And the IRS does also offer voluntary, non-binding mediation. So that is another option. After the closing conference, if the IRS determines that the taxpayer owes money, they will send a 30-day letter, which means the taxpayer's got 30 days to respond with the results of the examination. If the taxpayer does not respond within those 30 days, then they send this notice of deficiency. That is a 90-day letter, meaning the taxpayer's got 90 days to respond. But this is the more formal, like, okay, you didn't respond. This is that notice of deficiency that gets issued. Taxpayer does have certain rights during an audit. They've got the right to professional and courteous treatment by the IRS employees, a right to privacy and confidentiality, the right to know why the IRS is asking for certain information and what they're going to do with it, a right to representation, that's where you come in, and a right to appeal if they do not agree. Third party correspondence. The IRS may contact third parties as part of an audit. So it can be employers, employees, banks, neighbors, etc. In general, the IRS has to give the taxpayer reasonable notice before contacting any third parties and provide the taxpayer with a record of persons who are contacted. There are some exceptions, though, that are on the screen. If it is a criminal investigation, they don't have to give you notice. If providing that notice would jeopardize collections, then they don't have to. When providing the notice might result in reprisal against the person. So they're worried that if they notify the taxpayer that they are contacting someone, that the taxpayer is then going to go after that person. So this could be in a lot of circumstances, but for instance, it could be in a husband-wife situation, divorce situation. And if the taxpayer's already authorized the contact, then of course the IRS does not have to give notice. Repeat examination. So the IRS does try to avoid repeat examinations of the same items, but sometimes it happens anyway. So if your tax return was already audited for the same item in either of the previous 2 years and there was no change proposed, so they audited it, they said, yep, everything is good. Then if they try to audit you for that same issue again, you can contact the IRS and say, hey, you already looked at this. Do you really need to look at it again? So for example, let's say you've got a taxpayer that has a lot of medical expenses. So they've got a large medical expense deduction on their tax return. And it's because they've got legitimate medical issues. They just have a lot of medical bills. So it gets audited. The IRS finds that everything is fine, but then it triggers another audit because the next year they've got large medical expenses again because they've got this ongoing medical problem. That might trigger another audit. So that's a case where you could go to the IRS and say, hey, you already looked at this, and they may very well then say, okay, we will not audit you again on that issue right now. Burden of proof. It is the taxpayer's responsibility to prove all entries on their tax return, whether it's income, deductions, other statements. It's the taxpayer who has the burden of proof for all of those items. And some things, of course, have additional requirements, such as travel expenses, auto expenses, gifts, etc. However, if the case ends up going to court and the taxpayer does present credible evidence in their favor, then at that point, the burden of proof switches to the IRS. So now let's talk about appeals. You, as an enrolled agent, you may have been involved in a case all along, and now it's going to appeals, or you might not get involved in a case until it's time to appeal. So it could be a taxpayer has been using a different tax preparer, or they haven't been using a tax preparer at all, and now they've got an issue with the IRS, and they don't agree with it, and they want to appeal, and so they come to you, and you are going to represent them in appeals, even though you weren't involved in the case before. Either way is perfectly fine. So the taxpayer has the right to appeal an unfavorable finding in any audit or other IRS decisions. Letters and notices will explicitly state if you have the right to appeal. So you get one of these letters, and it should say, sometimes they leave this off, but the letter should say, that you have a right to appeal and you have to do it within so many days, and just basically outline what your rights are as a taxpayer. There are different ways that the appeals can be done. You're going to start generally with appeals within the IRS itself. So they have an appeals system. You can also go to the U.S. Tax Court or to the U.S. Court of Federal Claims or U.S. District Court. If you are going to the U.S. Court of Federal Claims or a U.S. District Court, you have to pay the tax first. So you pay the tax and then you sue the IRS to get your money back. If it's the tax court, you don't have to do it that way. You can just not pay. You can say, hey, we don't think we owe this amount. Take it to tax court, and then the tax court will make their decision. And if you have to pay, then you pay. And if you don't, then you never had to pay and you were never out that money. But if you're going to district court or the federal claims court, then you have to pay first and then sue for refund. So let's talk about the IRS Appeals Office. So appeals is an independent function of the IRS. It is the only level of administrative appeal within the IRS. So if you go through the appeals office and you're not happy, then you got to go to court. That's your next step. Appeals employees strive to fairly settle disputes between taxpayers and the IRS, and they consider the arguments on both sides, and then they apply the relevant law to the facts. Now, it's easy to be cynical and skeptical of this, but usually the appeals employees are really trying to be fair. Of course, it's going to depend on who you get and whether or not they're having a good day. So there can be times when they don't really seem like they're being fair. But overall, at least their intent is to be fair and to settle the disputes, considering both sides, all of the arguments, and then applying the law as it should be applied to the facts at hand. Most disputes can be settled either informally, meaning without having to go to appeals, just talking to the IRS employee and their manager, or at the appeals level without going to litigation. So you're going to read tax cases, and you're going to see lots of cases in the tax court. And if you're reading a lot of cases, you may get the impression that lots of cases go to court, but that's just not true. The vast majority of cases are settled way before they go to court, and they're settled either without even going to appeals or through the IRS appeals office. And you, as a representative of the taxpayer, will be the one doing a lot of those negotiations and coming to those settlements with the IRS. You can request an appeals conference by filing a formal written protest. So the formal protest should include all of these things. So you're going to say what's being disputed, why you think you're right, whatever laws or IRS notices or whatever proof you have when you did your research for why your position is right. And then that does have to be signed under penalty of perjury. So the taxpayer signs it under penalty of perjury. Now, you can sign this instead as a representative. So if you've been hired to represent the person, you've got your power of attorney in place, you can sign it. So if you are signing it, you are not swearing that everything is true because you're not the taxpayer. You don't have 100% knowledge. You're just relying on what the taxpayer said. So if you are signing it, you are just saying, this is true as far as I know. From the information that I have, everything in this letter is true. But in either case, it has to be signed either by the taxpayer or by the taxpayer's representative. If you've got a small case, which is defined as $25,000 or less that is due, then there are simplified procedures. You don't have to have a formal written protest. You can just prepare a brief written statement with all the disputed issues, why you disagree. You'd still want to put in there if there's any support you have, you would want to put in the support for that. You can complete this appeal on a form that's included with the letter you received from the IRS, or you can complete this form 12203. So when you get a notice from the IRS, if it's under this $25,000, they will include in there, they'll say, hey, you have the right to appeal. Here's how you appeal. And then they'll actually have a little form with little lines, and you can write on there, we want to appeal. This is why we think we're right. And here's whatever proof we have. And then you can include, if there's any documents you want to include, you can send those in with your letter. So this is kind of an easier way to do it if you have one of these small cases, but you don't have to do that. You can always complete the form 12203 instead. As with an audit, when you have an appeals conference, so you're going to meet with the appeals people. The taxpayer can go themselves, or they can have you with them, or they can just send you in their place. And of course, it has to be one of the people we talked about before, an attorney, a CPA, or an enrolled agent with a power of attorney on file. 90-day letter. So this is that notice of deficiency that we talked about. If you go to appeals, you cannot come to agreement, then the IRS is going to send this notice of deficiency. The taxpayer cannot appeal to the U.S. tax court until they've gotten this 90-day letter. So you have to wait for the IRS to send you the notice of deficiency before you can appeal to the tax court. Once you get the letter, you've got 90 days to appeal it to the tax court. And once you file the petition with the tax court, then the case goes back to appeals one more time. So the tax court doesn't want to hear cases, honestly. They're busy, and they would rather that the IRS and the taxpayer reach an agreement. So once you file the petition with the tax court automatically says, okay, you need to go back to appeals. And so you're going to go back to the table. You're going to negotiate again, try to come to some agreement. And then if you still can't do it, then the case can proceed to the tax court. If it goes to court, then you as the enrolled agent are kind of out of the picture. I say you're out of the picture. What it means is you can't represent the taxpayer before the court. You have to be an attorney to do that. You may still be involved. I mean, you may be involved behind the scenes. You may be supporting the attorney. The attorney's asking you for information. You're providing information. You're giving your opinion, et cetera, and so forth. But you can't be the one that actually represents the taxpayer before the court. That needs to be an attorney. Now, there actually is a path for non-attorneys to practice before the U.S. tax court, not any other courts, like not the district court, but before the U.S. tax court without being an attorney. You can sometimes, if you apply and you pass a test, you may be able to do that. So you want to know that that is available for the exam. And if you're interested in that, you can go and do your research on that. But again, the general rule is you have to be an attorney to represent someone in court. And that is the end of our discussion on representation before the Internal Revenue Service. This can be a very interesting and rewarding part of your tax practice. So if it's something that you think you are interested in, you will want to look into it more, find out the ins and outs, and see how you might get into that side of the business. And with that, we have only one more video left, not only in part 3, but in the entire series. So I will see you on video 4.